Investors gain access to the underlying asset, but they also get a second tier of protection. Their holdings are oftentimes guaranteed by the balance sheet of the underlying company. Over time, Bitcoin continues to be an uninflationary hedge, a store of capital, consequently. We have a wholly owned subsidiary called Stillman Digital that has done something like 60, I would probably say 50 to 60 billion in OTC transactions. Sovereign debt is the largest asset class by a significant margin. I think it's like a third of all global debt.
Today, we're looking at the company that sits at the intersection of regulated capital markets and decentralized finance. DeFi Technologies, through its flagship brand Valour and the suite of strategic subsidiaries, is bridging traditional brokerage rails, exchange-traded products, algorithmic trading, liquidity, infrastructure, research, and venture capital into the digital asset economy. In 2025, Valour posted record 138.2 million net inflows into its ETPs and expanded to 102 listed products offering regulated exposure to broad digital asset spectrum. Our guest today is Andrew Forson, President of DeFi Technologies and Chief Growth Officer at Valour. Andrew, welcome to the show.
Thank you so much, Nasib. It's a pleasure to be here. Thank you for having me.
Thank you very much, too. So let's begin with your background, right? So what is the origin story of your involvement in digital assets and decentralized finance, and how did that shape your vision for DeFi Technologies?
Okay, well, I guess my origin story is quite unexciting. It's like most people, you start working in business, and I've always had a keen interest in computers. I started programming my first computer programs at the age of 7. And what happens is increasingly there's been a convergence of technology and finance. There's a time where finance was more the domain of accounting. Increasingly over time, as people tried to gain competitive advantage and additional insights, they would leverage data. And that process of leveraging data in order to yield alpha or higher than standard financial returns ended up spawning into a field called financial engineering, where that's the intersection of statistical science, of finance, and the creation of structured instruments to generate a particular targeted yield. I was fortunate enough to be coming up at a time where I'd been working in accounting and I'd worked at Deloitte Consulting on the value-based management practice, and then later on some ERP implementation work. And I became very, very curious as to how companies were valued because people would always decide, excuse me, people would always make core decisions on the basis of company valuation. But the practice of valuing a company is more an art than a science. And back before I had started studying financial and risk engineering, I didn't actually understand anything beyond the accounting treatment of how to come up for a price for a company. So in that process, you end up working with more advanced computer technology, particularly when you start studying financial engineering, which I did at George Washington University in the US and through a variety of certificate and training programs. And you realize that the power in valuing a company or finding opportunities in the market comes by being able to leverage technology and the speed of networks better than others. So back in the day, we actually used to develop neural network algorithms, which was the precursor to machine learning, which is the precursor to today's AI, all in the interest of trying to figure out how either trading patterns or certain macroeconomic indicators would mesh with the core indicators a company is producing. And then you could find ways of investing in companies that otherwise would be tough to discover, but are generating higher returns or have the potential to generate higher returns than the other companies that are normally listed and very well known. So as I went along on that journey for much of my career, building these software systems that linked finance and technology. Obviously, in the mid teens of the 2000s, there was this interesting thing called blockchain. And I remember at the time I started looking at Hyperledger, and I didn't actually start looking at Bitcoin because Bitcoin wasn't really the most programmable blockchain at the time. So I was looking at Ethereum. I was looking at Hyperledger because Hyperledger had enterprise adoption. And then the first chains that I started to work with were XRP, Cardano, and then Hedera. And it was at that time that I started to build like small wallet applications, started to issue tokens, started to look at NFTs because NFTs were very interesting. Particularly, they had a lot of demand in the market. But I never, maybe foolishly, but in the long run, I think it's worked out. I never looked at blockchain or Web3 from the perspective um, of trading and speculation. I always looked at it from the perspective of building enterprise systems, understanding how they could be used, understanding how the infrastructure could, how Web3 technology could be applied to current infrastructures, because I viewed it as something that was going to be internet adjacent, that its very nature of um, being trustless in that when something is published to the chain, everybody has access to that information outside of Hyperledger, which is somewhat of a proprietary internal system. I thought that it had a lot of potential to rewrite finance, global finance in particular. And it seems that that has actually been coming true with stable coins, tokenization, real world assets, and otherwise.
I see. And DeFi Technologies operates at the unique nexus, right, of regulated asset management, proprietary trading, research, and liquidity. So, how has your prior experience informed how you integrate these lines of business?
Yeah, I feel incredibly fortunate to be working for DeFi technologies within DeFi technologies because what you'll find is that the people who are Web3 native tend to be very, very steeped in blockchain culture, technology, and it's very exciting. They've been able to create a lot of capital in some instances out of nothing. I mean, in some instances, if you create a layer one blockchain and you have a token sale, it absorbs a lot of capital, but it's not like you needed a great deal of resources to be able to create this chain to have your utility token or native token offering. Consequently, there is somewhat of a dearth of traditional financial thinking in the Web3 space. It tends to be focused more on marketing, community. Increasingly over time, people are having to ensure that their blockchain projects actually make money. But in the early days, the whole idea was how many users can you get, and it will make money eventually somehow. Now, obviously, coming from a finance background, that didn't make too much sense. I mean, ultimately in finance, we're always examining things from the perspective of risk, of volatility, and really the discounting of future cash flows to a present value to figure out what is this worth. So whenever you take that thinking and you merge it with the world of Web3, it's tricky because particularly in my prior role as a head of a venture capital division of a layer one, it's hard to find great projects and it's hard to communicate to people that, look, your company or your project actually has to make money for it to be sustainable in the long term. Marketing and hype in and of itself will not pay the bills. It can for some time, but it's not necessarily sustainable. What I love about DeFi technologies is from a fundamental business perspective, we're probably one of the first companies to profitably service the Web3 industry by wrapping digital assets into capital market instruments that traditional buyers can purchase, add to their portfolio, but we do this profitably. So we solved a problem in that we made digital assets consumable by traditional investors. And we had a great pedigree in doing so. Our now founder and chairman and CEO, Johan Wattenstrom, was a gentleman who, back in May 2015, created the world's first Bitcoin exchange traded product. Now, for many of your listeners, they may be thinking, yeah, but I thought that Bitcoin ETFs came into existence in, I think, maybe 2022 or 2023 in the US. And you're right. Johan was so much of a pioneer, he was 7, 8 years ahead of everything that's been taking place in the US markets now. That sort of thinking permeates everything that we do at DeFi Technologies. We focus on innovation. We focus on being incredibly open-minded to the strength and power of digital assets. But most importantly, we focus on doing so profitably. Our number one consideration is how do we generate a profit from the activities that we're going to undertake? We're also particularly concerned with being completely vertically integrated. So we like to own our entire tech stack, from custody, in some instances, staking nodes, yield generation, all the way through to the prospectus generation, the packaging of the instruments, and the issuing of the instruments onto the exchanges. And once the instruments are issued onto exchanges, we also have a market making desk to ensure that price slippage between quoted price and what the individual actually purchases is held to a minimum, and the spreads so that when people buy and sell, they don't have to incur a penalty for buying and selling. We like to keep our spreads incredibly uniform and balanced. So in this way, DeFi Technologies and our subsidiaries Valour and Stillman Digital enable us to really intersect the world of traditional capital markets and the world of decentralized finance for profit and value creation.
Talking about ETPs, right?
Yeah.
Why do institutional allocators continue to favor ETPs over direct crypto holdings, and which regulatory, custodial, economic, and operational considerations carry the most weight in that decision today?
Okay. That's actually a great question. And the answer comes down to ease. Now, today it's gotten easier to purchase digital assets. We have wonderful companies like Coinbase, like Crypto.com, Binance, the list goes on, where you can set up an account and buy the digital assets. But that said, setting up an account and buying the digital assets is still a relatively new process, and finding out which assets to choose, how to store them if you decide to move them from the custodial account platform to a non-custodial account platform is a challenge. Now, for our viewers and listeners, a custodial account in the world of decentralized finance are a set of wallets that are held and controlled on your behalf. A non-custodial account is a platform that would enable you to connect a wallet for which you hold and own the keys directly yourself. Now, whenever you're dealing in the world of brokers and dealers and traditional brokerage accounts, this world has been established for well over 100 years. So the laws, the means of holding these assets has been so well established that it is easy for people to invest. It's easier for portfolio managers to manage assets on behalf of the clients. And most importantly, it's easy for accounting, taxation, reporting, and trust and estate planning purposes. Whenever you're dealing with specific wallets on specific chains, And if you're buying particularly from a decentralized exchange, as opposed to a centralized exchange, there are a number of variables that come into play. You have to figure out how you manage the wallet and the wallet keys, and understand that many of those wallets, in the case of some chains, are actual nodes. So that means when you download the wallet, sometimes you have to download an entire copy of the blockchain onto your system. So there are some chains where when you go to just check your balance, it's almost frightening if you haven't opened that wallet in a lot of time, because it can take days to download a copy of the chain in order for you to have a current record of your balance. And that's one chain. Now, if you want to be exposed to the broad array of tokens in order to be able to execute a particular business strategy, imagine having to run wallets on all of these particular specific tokens and being able to manage them. That means including updates, and they update often because they have security patches and everything of the sort. This means you almost have to become somewhat of a Web3 DevOps engineer just to hold the assets. And even then, how often have we heard of potential security lapses and whatnot that have resulted in loss? So this is where the exchange-traded product comes into play. Via the exchange-traded product, there is an extensive multi-year regulatory process for ensuring that investors gain access to the underlying asset, but they also get effectively a second tier of protection because their holdings are oftentimes guaranteed by the balance sheet of the underlying company. On top of that, every regulator goes through and makes sure there are adequate security protocols, there's adequate investment protocols, there's adequate pricing protocols, market making protocols, and liquidity for each instrument. So what does this all mean? It all means that via an exchange-traded product, you gain access to the value or the actual assets of the underlying ETP, but you don't have to deal with a lot of the technical uncertainty associated with custody, yield, staking, wallets, keys, which make it otherwise unwieldy. But from a broader perspective, because I know, I come from the Web3 world, so I know a lot of people, they'll say, oh, well, not your keys, not your tokens. But from a broader perspective, the law has more oversight over what is happening with an ETF and ETP issuer than over somebody who may issue a token on a specific chain and then basically liquidate a lot of the issuing position so that you're held with something that has little to no value in the end. So on the other side of it, there is additional value whenever it comes to liquidity, because what is happening is the regulators are very keen to ensure that there is an efficient market. So you tend to have clarity of pricing, clarity of fees. So if the prospectus of the digital asset ETP that you purchase has a fee schedule of 1.9%, you know you're not going to be paying anything more than that for having access to secure access of the token, ensuring that the token that you're buying is the actual token. So there's no chance that you're going to be buying a BTC token that somebody else minted on another chain, used that ticker symbol, and then you think you're buying Bitcoin when in all reality you're buying nothing. So there are so many of these sorts of scams, but in the case of investing via an ETF or an ETP, you have an ISIN number. It is regulated, oftentimes by multiple regulators, by law. It is double protected by the underlying company, the issuing company's balance sheet. You have audited statements to ensure that the issuing company is doing what they're supposed to do, and you have a high level of assurance, almost 100%, that the issuing company is actually selling the underlying token that they say that they're selling. On the other side of it, once again, another very important consideration is estate planning. So if I have purchased a lot of token and I have access to the keys and I've memorized the keys, or I've put the keys, I've written it and I've tucked it in a jar someplace in my house, and I happen to get hit by a bus, um, that wallet may end up holding that crypto forever. And my relatives, my family, children, anything like that will not be able to gain access to it, even if the courts say you're entitled to those assets. But whenever you are purchasing through a standard brokerage account, uh, estate planning is facilitated because they're using traditional finance rails. So there's a lot of ways in which the modern move towards exchange traded products facilitates the movement of capital into the digital asset market space, out of the digital asset market space, and enables more individuals, retail, and institutional investors to participate.
Even in challenging digital asset market, Valour recorded estimated net inflows of 138.2 million in 2025, its highest on record. From an institutional perspective, what is the deeper signal net inflows convey that raw AUM on assets under management numbers might obscure?
Yeah, I think that's a great question, and thank you for that observation. I think my personal opinion is the ability to manage inflows is an independent variable that the company is able to use to measure its efficiency. Assets under management, like the actual pricing associated with the assets, is a function of the inflows, stored capital, and the market conditions. And as you no doubt have seen, as of the filming of this particular podcast, market conditions can change very quickly, particularly when you're in an environment of volatile politicians, volatile macroeconomic indicators. If a politician sneezes the wrong way at a particular country, before you know it, everybody says, oh my goodness, there's going to be a war or something terrible. And then there's a flight to liquidity, out of liquid assets into gold, out of one currency into another. And unfortunately, for those of us who are digital asset lovers and native, sometimes that results in a flight to quality out of digital assets into more traditional assets like gold, and in many instances, things like highly rated sovereign debt. So, what we always focus on is how can we be more efficient as managers? And that efficiency for us is measured by our ability to have continued inflows in good market conditions, which admittedly is easier, but also in poor market conditions. Because at the end of the day, if you look at the annualized return of Bitcoin, certainly up until the 10th of October 2025, you're looking at Bitcoin having an annual return of 30% per annum. That's excellent. If you look at last year's annualized return of the S&P 500, which is an index of 500 indicative U.S. equities, the S&P 500 had an annualized return of 25% in what was considered a banner year. So, all things considered, over time, in the long run, Bitcoin continues to be an uninflationary hedge against inflation and a store of capital, consequently. So, those of us who understand the digital asset space, who have an appreciation for it, have no doubt seen multiple movements in digital asset prices, most noteworthy Bitcoin. We know that that asset price is going to go up and it's also going to go down. But generally, because at the end of the day, there is a maximum supply of 21 million units, that asset price will likely go up over time. So, our main concern, being an asset manager, is to see how we become more and more efficient of by ensuring that investors who are seeking to invest, they're able to do so. And the best measure for us of that is having positive net inflows, meaning more people are buying into our library of exchange traded products than selling out of over the course of a month.
Valour's suite includes 102 exchange-traded products, the most diversified regulated digital asset product shelf globally. What's the strategic rationale for breadth, rather than specialization in ETP offerings, and how do you see institutional demand evolving across that spectrum?
Uh, that's an excellent question. I think the main strategic objective of Valour is to provide a broad-based institutional and retail access to the widest array of quality digital assets. So it's not necessarily our job to be the arbiter of who invests. We don't want to come in and create an instrument after it is deemed to be popular and acceptable by the market. We work closely with foundations and have a research division that looks at instruments that are up and coming, that are well regarded on the Coin Market Cap 100 or Coin Market Cap 300, and we create these instruments early in anticipation of movements in the market that will be positive. Now, this has resulted in something quite unique. This has resulted in us having the most indicative array of digital assets that indicates to the market most efficiently what digital assets are doing the coolest things in the market and what cash inflows are moving into these digital assets. If we only focused on the top 5, we would obviously be able to generate revenue, and we do have all of the top 5. But one thing people have to understand is many of the most innovative developments, chains that are supporting AI, chains that provide infrastructure and rails for stable coins, those are in what we call the altcoins, the alternative coins. So Valour offers ETPs in 74, as of today, 74 individual digital assets. Many of those long tail altcoins provide significant infrastructural services for stablecoin issuance, data centers, energy, RWA, which are efforts to securitize traditional assets and bring them on chain. So if we didn't have these ETPs, some of which are quite popular, investors would not be able to have access to these innovations early, and therefore they would be losing out on a significant potential for capital appreciation.
The Valour model monetizes not just through management fees, but through staking yield, trading, internal IP, node operations, and MEV. How does that multi-pillar monetization strategy position Valour differently than traditional asset managers or passive ETP issuers?
Yep. That's a very good observation. So if you recall, in my initial statement, I mentioned that we really like to own the entire vertical technology stack. And the rationale is we believe if we own the technology stack, like in our January CEO letter, it was announced that we're also moving into the custody space. We're able to actually pass on more value, more instruments to the people who invest in our ETPs, but we're also able to maximize value for our shareholders because our cost basis will be lower because we don't have to pay third parties to provide services that we're able to provide in-house. And anytime you're not paying for a cost, that means your margins are higher. So this philosophy of in-housing a lot of technology activities from staking, yield generation, all of the above, basically translates to higher potential returns for our shareholders and more efficiency for our investors. It also means we're able to offer innovative products on the market. Earlier this week, or perhaps it was last week, it was announced that 2 of our ETPs have been approved on the London Stock Exchange for retail adoption. One of those products is a Bitcoin yield generating exchange traded product, and the other is an Ethereum yield generating exchange traded product. Now, the nature of these products mean that when an investor goes to their broker, for instance, in the UK, to purchase one or both of these Valour exchange traded products, they will not only benefit from the potential of capital appreciation of Bitcoin and Ethereum, but they will also have an additional yield kicker on top of the capital appreciation. We're able to execute on this because we, within our own infrastructure, we run nodes, we have partnerships for the establishment of nodes generating yield, and we're able to provide a degree of efficiency because of that vertical technological integration.
A lot of digital asset products are tied to Bitcoin and Ethereum. How do you assess and price the risk reward when opening ETP exposure to more nascent protocols or DeFi sectors within the regulated product umbrella?
Yeah. So it's a combination. I think the decision-making process on whether an instrument should be listed is a combination of, is there sufficient liquidity in that instrument? So we don't want to list an instrument that if an investor buys into it, they can't sell, right? There are no sufficient counterparties for selling. And a lot of that is determined by how present the actual instrument would be on the premier, the top 10 centralized and to some extent decentralized exchanges. Another element of that is the maturity of the foundation. So, is the foundation that is supporting the underlying token actively courting a community, courting projects, and having a good result with their token? Now, we are not necessarily the core investors in the token itself. We are more an intermediary that gives the traditional capital markets access to these digital asset markets. But in order for us to do that properly, we want to ensure that the spreads are narrow, that investors will have a good flow of information regarding that particular digital asset. And that is a function of what that foundation is doing in the market, how that foundation communicates. And we also want to ensure that there's sufficient liquidity in the market so that if a large institutional investor wants to make a large block purchase, it doesn't result in massively moving the price of the token through one transaction. If all of those conditions are satisfied, then it's highly likely that it would be a strong candidate for the development of a single underlying digital asset exchange traded product.
Thank you for the answer. And how do you determine which digital assets merit as ETP and ETP listing, particularly beyond Bitcoin and Ethereum? You elaborated on that partially. Maybe we could add a few more details. Namely, what quantitative and qualitative thresholds must be met in terms of liquidity, network fundamentals, or regulatory clarity?
Yeah, I think actually a lot of it is determined at a high level by our prospectus. So we have to file a prospectus with the Financial Services Authority in a number of countries, primarily Sweden in our case. And in that prospectus, we give an indication of the pool of digital assets that we would be likely to issue an instrument against. And normally, excuse me, a lot of the characteristics that you're mentioning, liquidity, market cap, volume, foundation, those are somewhat encapsulated by the activity or the AUM, the total asset value and interest in the coin market cap 100. So you're looking at most instruments that we have listed tend to be represented within the coin market cap 100. Certainly within our prospectuses, there's leeway to go a little more than what is listed on the coin market cap 100, but that's a good rule of thumb.
Mhm. And Valour's ETPs reportedly generate a blended yield of 5-7% through staking and management. Can you break down that yield composition? and how it compares to traditional asset management fee structures.
Yeah, I don't think I think the yields often differ based on the tokens because different tokens have different staking yields associated with them. So, for instance, our Bitcoin yield product, because it uses an integration with the Core Foundation, the yield on that product will be less than the yield on a token associated with, say, Avalanche or Solana. So these figures and how we arrive at them are somewhat, uh, I won't say that they're proprietary, but they're somewhat sensitive. We certainly have a lot of information about these things within our financial statements, but the allocation is obviously tied to the assets under management by individual ETPs, and then we have an internal a very intelligent team of internal traders and analysts that do their best to maximize the yields on all assets that are held and managed by Valour.
Let's stop for a minute. Here's a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. There is a vertical integration of Valour from issuance to liquidity provisioning, right? So how does that full stack control reduce tracking error and slippage in your ETP products, and what proprietary advantages does it unlock?
Well, we have a number of proprietary advantages. I mean, I think uh, the fact that we have an internal market making desk, it helps us. Our objective is to maximize inflows into our ETPs. So the process of providing market making services makes it easier for buyers to enter and sellers to exit with relatively predictable spreads. We are not necessarily subject to external market makers that might have very broad spreads, which might discourage investors from entering into a particular digital asset. So that's one aspect. The other aspect is we have a wholly owned subsidiary called Stillman Digital. And Stillman Digital is a liquidity provider that has done something like 60, I would probably say 50 to 60 billion in OTC transactions into digital assets over the last around 2 years. Now, the advantage of having a Stillman Digital is able to execute on block trades for institutions that want to take a large position into a digital asset. They're also able to provide liquidity as a counterparty for exchanges on specific digital asset trading pairs. So, having them as a significant part of our operating stack and portfolio means we really have good control over liquidity through market making, through Stillman Digital. We have good control over visibility and pricing through our interactions in our market making, our ETPs, and Stillman Digital. All of this works to maximize both liquidity and efficiency in how we operate.
Valour, Valour has had no month of net outflows. What risk management or portfolio construction strategies helped maintain um, that level of success?
Yeah, it's not so much a portfolio construction strategy. Well, it is to some extent. I think the fact that we're broadly diversified helps. I mean, if our only product was, for instance, Bitcoin, I think it'd be evident that in the last week, if that were our only product, we would have massive outflows because Bitcoin has had significant outflows in the last week and has certainly had significant outflows since the 10th of October 2025. But what happens is, and this is the basics of finance, having a diversified portfolio, certainly you'll have instances where some money that leaves Bitcoin might seek haven in another digital asset. For instance, we also have an XAUT, the Tether Gold underlying ETP. So, in a time of digital asset uncertainty or volatility, you might find that some money might move more into an XAUT digital Tether Gold ETP. So, in this case, Valour, being a provider of a number of digital asset products, is able to provide investors with the opportunity to diversify their exposure to digital assets. Now, on the other side, increasingly, particularly within the last year, we've been very, very visible at conferences. We've been visible at industry events, and most importantly, I spend most of my time speaking with banks and investors in the traditional finance world all around the world, from the Middle East to Europe, Latin America, Asia. So that means we are not necessarily relying exclusively on the capital that we already have in-house, but our objective is to attract individuals and institutional investors that are digital asset curious, who would like exposure to the assets in a regulated, secure way. We're attracting them into our portfolio products. And in many instances, they may have heard about a particular digital asset that is associated with a stablecoin or associated with a liquidity protocol, and they would like to know how they can gain exposure. And our job is to tell them that, look, this is what the digital asset is, this is the information about the foundation, and you can gain exposure via this ISIN. So it's a combination, as I mentioned before, of not only the vertical integration of how we do our work, but it's also the fact that we're trying to be very, very efficient and proactive in introducing potentially new customer bases to our existing operations. One of the big things that I'll actually be unveiling this week, so you're sort of getting a scoop on this, is at a high level, we have undertaken a massive data analytics operation and a massive effort to demonstrate that within the Valour ecosystem of products, there are interesting data points that can give the digital assets investor the opportunity to generate alpha through the selection of specific Valour ETPs. So through this data operation, it also helps us to become more efficient because we can see where the money is going and how we should be promoting a particular ETP that backs a momentum-focused investment thesis.
I think your answer also connects well with the next question that I wanted to ask about, you know, a risk of over-diversification, diluting the liquidity and of investor interest across too many products, right? So I think it pretty much answers that. Maybe something else you wanted to add.
Yeah, no, I think that's a very good concern, but we have to remember our job is not as an investment picker. We're not actually a portfolio manager. Increasingly, and I think people will see that in the coming weeks, we're like a market unto ourselves. So just as a stock exchange is actually more valuable by the more instruments it exposes its investors to, we too, our value tends to be somewhat tied to the more instruments we expose our investors to. It's not our job to pick the winning digital asset, create an ETP, and hope that becomes the best. Our philosophy is to create the ETPs that obviously meet certain liquidity, operational security, and value thresholds, as we discussed previously. But our primary objective is to make these available to investors in the most seamless, efficient, cost-efficient, and transparent way possible. So there doesn't tend to be a conflict. If you want Bitcoin, you can buy it, our Valour Bitcoin ETP. If you would like access to Hedera or Cardano or Solana, we have Hedera, Cardano, Solana ETPs. In some instances, those ETPs also give rise to staking yield returns. And if you're looking for index products, we have products that track the top 10 index of, or the top 10 coin market cap index digital assets. We also have products that offer levered returns, so 2-time returns of Bitcoin up or down, 2-time returns of Ethereum, et cetera, et cetera.
Are you exploring synthetic or leveraged digital asset ETPs or products linked to volatility indices and cross-asset spreads?
Yeah, absolutely. I mean, that's one of the benefits of, I guess, working for Valour and within DeFi Technologies. For one, you can certainly check. We are a significant shareholder. At one time, we were over 51% shareholder. Now, through other investors joining the cap table, we are under 50%. But we are a significant large shareholder of a Swiss-based asset manager called Neuronomics. And what Neuronomics does, they have their asset management license. They use artificial intelligence to create innovative trading strategies that could be that are applied to digital assets. And without a doubt, we are in the process of creating and preparing to issue certain AMC based products. AMCs are management certificates based out of Switzerland that they effectively are investment products born from Switzerland. They're actively managed certificates. In this case, the active managed part is being driven by algorithms that are based upon psychological trading and artificial intelligence trading algorithms. So that will be definitely an interesting product. I believe back in around December 17th, we issued a 2-times return levered product for Bitcoin and Ethereum. And I think that is definitely the future of where Valour and Valour products will be going, because we can't issue 1,000 different ETPs on 1,000 different tokens. But what we can do is leverage the information, the knowledge that we have, the technological base that we have to be able to create innovative instruments that hybridize 1, 2, 3 tokens or create unique alpha tracking innovative instruments that are designed to generate specific return profiles for hedge funds, capital market allocators, or for individuals too.
What kinds of investor behaviors or portfolio goals are shaping what that next wave of ETP design?
That is a great question. I think ultimately, the digital asset space is becoming more sophisticated in that investors are more they're more risk averse. There is less of a tolerance. Not that there ever was a tolerance for rug pulls, but there's less of a tolerance for the potential to invest in projects that can go to zero. Unlike back in the NFT days, it was like the tulip mania in the Netherlands hundreds of years ago, where people were just speculating so heavily. Investors are now entering positions on the basis of the quality of the underlying technology and the market, the potential, or the use case associated with a digital asset. And that is something that is very, very interesting. I would say another key development is that they are willing to leverage, they're willing to bring a bunch of technologies together to explore the ability to generate much higher returns using technology. So if it means using algorithmic tools to rapidly trade in and out of positions, but in a systematic way, there are many institutional investors or hedge funds who are looking for specific strategies to complement their portfolio, right? And that's something that is quite prevalent and definitely, I think the future. I think in the future, you will find that just as some time ago, portfolio managers would say you should have a percentage of your portfolio in precious metals, a percentage in fixed income, and a percentage in equities, there will also come a time in the not too distant future where there'll be an expectation that a percentage of your portfolio is in digital assets and a percentage of your portfolio is governed by algorithmic trading engines or AI. I think that that time is upon us.
Makes a lot of sense. So there is another topic of tokenized sovereign debt, right? Maybe we could briefly touch upon it. Um, Stablecoins increasingly influence demand for sovereign debt, as we know it, particularly U.S. Treasuries. With research linking stablecoin growth to yield curve effects, how do you see that dynamic influencing the appetite for tokenized real sovereign debt?
This is inevitable. This is an area that I continue to work on. I research. Look, anytime you're in a situation that brings liquidity and efficiency to a market, you can't stop it. We saw this with the advent of the internet. The internet made communications easier. There were times where people would say, well, you can't accept an emailed document as a legitimate document. You got to send a fax. I haven't seen a fax in ages. And it's actually interesting because sometimes I'm in an office and I say, okay, look, I'm ready to sign the documents now. And they'll say, okay, well, we'll just send it via DocuSign. It's easier. So there's actually a preference for DocuSign to wet ink in many instances. And I think sovereign debt is the largest asset class by a significant margin. I mean, I think it is not an underestimation to say that the sovereign debt asset class, as an individual asset class, as a fraction of debt, I think it's like a third of all global debt, and it represents about $100 trillion market per year. And that's at the sovereign level. There's also agencies below sovereigns. Like if you look at a country like Germany, Germany issues bunds at the federal level, but then you have cities like Berlin that are also issuing very high quality AAA rated debt. And the great stablecoin companies like Tether and Circle, they have figured something special out, particularly Tether. I mean, at any one time, I think Tether now is something like the 17th largest holder of treasuries, US treasuries in the world. And they are definitely one of the largest holders of gold reserves in the world. Tether is basically a virtual central bank. It's a virtual and private central bank. And in many instances, and this is the market speaking, it's not me opining, in many instances, in many countries, the citizenry trust Tether more than they do their own central bank. I mean, if you think of it, there are in many countries, they're far more interested in accessing USDT than they are in holding their savings in the native currency issued by the central bank of their country of citizenship. So when you look at it, you have basically outsourced central banking activities to a company like Tether. Now, the tokenization of debt, this is something that is also near and dear to my heart. The entire Web3 blockchain tokenization argument, we have to remember it's just technology. It is technology designed to speed up the transfer of assets to create more efficiency. And with more efficiency, you should have more transparency and more liquidity. So instead of it taking T plus 2 to settle a trade, you can now settle a trade in T plus 0, right? So when you look at something like this, it's clear to see that this movement is not going to stop. It's a matter of, are the regulatory environments going to be intelligent enough to keep up with these changes, or will these changes just carry on either underground or in from jurisdictions that are quite proactive or advanced whenever it comes to permitting such activities? But without a doubt, I think that it's going to create a lot of liquidity. Right now, the US market is the prime benefactor, but in the same vein, when something is very easy to buy, it is also very easy to sell. So like, it's a bit of a double-edged sword because liquidity can work in both directions.
Mm-hmm. And what are the key regulatory and technical enablers necessary for sovereign debt tokenization to become investable by institutional clients?
Yeah, well, I think Tether has sort of proved that it doesn't necessarily need a lot of regulatory approval to make this stuff happen. What it needs is people to trust that what it's doing is effective. But this hews back to my original statement. The beauty about blockchain is it is largely trustless. If you're willing to take the time and you have a good chain explorer, you can actually get a good sense of what is happening on chain. If tokens have been minted against real assets, particularly if the entity has proof of reserve or not. I mean, we as DeFi Technologies, we have led in, or we have invested in, we didn't lead the rounds, but we were part of rounds as significant investors in the CNGN Nigerian Naira stablecoin, and also the QCAD from Stablecorp, which is the Canada's first regulated Canadian stablecoin. And the work that these entities put into providing proof of reserve, tracing transactions, KYC, AML, and making sure that their stablecoin products are reliable, I guarantee you that the average citizen has more transparency of how currency is issued with stablecoin issuers than they do trying to figure out M1, M2 liquidity of the US dollar, examining the linkage between the issuance of central bank backed sovereign debt and central bank backed currency. And I should correct myself because the central banks don't issue the sovereign debt. They sort of execute on policy. Normally, it's a Ministry of Finance or the Treasury Department that is responsible for the issuance of the sovereign debt, but then monetary policy flows from the sovereign debt issuances. But the correlation between the two is not necessarily one-to-one, whereas the correlation between the marketable securities that stablecoin issuers hold and the issuance of the stablecoin is frequently one-to-one. And when it isn't, when there's a fracture between that peg, we see it almost immediately. You look at something like a Luna. We all recall that. It caused such massive disruption in the market. We're able to see that. Same thing when Silicon Valley Bank was having liquidity issues. Their liquidity issue was an asset liability management issue associated with the duration of the assets on their books, which were too long, versus the liquidity requirements of their depositors. And by and large, depositors have short-term liquidity requirements. Now, in the case of Silicon Valley Bank, it turned out that Circle had a lot of short-term liquidity requirement deposits held at Silicon Valley Bank. But everybody knew that. There was good transparency about that. And the fault was not Circle's, because when you put your money with a bank, the assumption is that it's liquid. The fault there was with the traditional banking system that did not do proper duration matching associated with their asset and liability management. So, in many regards, I think stable coins are again another one of those killer apps because they're actually more transparent than what happens with our current monetary supply, in which case governments can issue more money, more fiat currency against the securities they have, which results in inflation. And you don't figure it out until many quarters afterwards because tends to be a lagging indicator.
How do you address concerns from institutional audiences that digital asset products, even regulated ones, may not yet have the robust investor protections they expect compared to traditional capital market instruments?
Honestly, I address that concern in this way. I think most regulators don't know how to code. And because they don't know how to code, or they're not necessarily mathematically inclined, they tend to be afraid of those things they don't understand. Back in the day, and I'm sure you'll recall, the argument was that digital assets could give rise to money laundering more easily than cash. And that to me was always shocking because you know, and I know that you can trace almost every transaction on chain almost right back to the genesis block of the transaction. So I think the concern is, and I've often said this, the biggest concern is there's confusion as to how you tax this stuff. And I think anytime that there is confusion about taxation, the default is to basically say it is bad, to sort of scare people away from the asset. Same thing happened with internet commerce. Back in the day, there was always concern about, oh no, it's not safe to transact over the internet. It was always, you could send an email, but you've got to like do the transaction offline. Right now, in many instances, it's considered safer to transact online than it is to transact offline. And I think eventually, as more people become familiar, just like with stablecoins, there's more proof of reserve technology and transparency with stablecoins than there is with the Fed. And this is a fact because we don't know on what basis the Fed is making buybacks. And I say the Fed, the US Federal Reserve. The US Federal Reserve is making buybacks, issuing paper. It's hard to match. If you go to treasury.gov and you try to track this, it's actually quite confusing. But whenever you try to track, for instance, I was looking at the transaction history and minting records and transaction volumes of the CNGN stablecoin in Nigerian Naira. It is so transparent. They can tweet it out. They have a dashboard on their website. And certainly Tether, Circle, QCAD, all other stablecoins that are legitimate have similar functionalities and operations. So I think it's actually a lack of understanding and a lack of appreciation of the strength of the technology.
With new entrants such as native stablecoins from decentralized platforms and the growing influence of tokenized derivatives and collateral, how do you see the competitive landscape changing for regulated ETP providers?
You know, it's I think anything that grows the total addressable market in the digital asset space is a good thing. The biggest uh, concern that I have is that we almost talk about the digital asset space always being in competition with each other and then in competition with other asset classes. But we need to put this into perspective. The entire digital asset space, I'm not talking about tokenized assets, which are digital representations of other asset classes, but native tokens. I mean, back in September, it was around $4 trillion. Now it's probably closer to 3.2. I mean, there's been significant value drop. But let's say it's 3 trillion right now. You have to keep in mind that the value of Nvidia is north of $4 trillion, right? It's like around $5 trillion now. So that means all this conversation that we're having is about a technology base that has a market value less than the value of one company. I only highlight that to show that the room for growth is actually massive. This would be like back in the day having the realization that all internet technology companies had the valuation of less than IBM, right? So we all know what has happened with the internet now. The internet and the infrastructure used to run the technologies that make the internet happen, the payment companies, all of the above, the Stripes, the Microsofts, the Amazons, all of those companies basically make up the Magnificent Seven, basically make up probably 80% of the value of the S&P 500, right? So I think without a doubt that the leading companies of tomorrow will be in some way, shape, or form tied to the digital asset space. It'll be indistinguishable between the two. And what this means is you have entities like us that, yes, we are an ETP provider. We do so profitably. We make money from that. But that does not preclude us from entering into the tokenization space. It doesn't preclude us from bringing more hybridized products like digital asset or crypto equity companies mixed with digital assets to create new fund products. Entering the custody space, for instance, because all of these digital assets, all of these tokenized assets, they all need to be custodied someplace. As long as they're minted on chain, they need to be held someplace. And it certainly doesn't preclude us if somebody has a tokenized derivative from us making an ETP if that tokenized derivative has a very interesting investment philosophy.
In building, in building, sorry,
No problem.
in building global distribution, including strategic expansion in markets such as Brazil, London, and Switzerland, what are the biggest operational challenges you've encountered?
That's a really good question because this is one of my central responsibilities. I think it's just, the regulators are very, very good, smart, and friendly. And I would say, particularly in the case of Brazil, it has been an absolute pleasure, actually. It went very smoothly. I think the biggest challenge is explaining to shareholders that something doesn't happen overnight. Brazil took 7 months, right? And that was a very healthy time frame. But then to grow a market, when you enter into a new market that has a different language, different culture, all of the above, you have to make the right connections. And you can only do a lot of these things in a step-by-step, data and analytically strong way. It takes time. But unfortunately, in these days, people's attention spans are somewhat reduced. So if you say you're doing something, then the very next day, everybody wants to know, well, what has happened? Like, can we get it now? Can we get it now? Can we get it now? But that isn't how governments, regulators, and exchanges work. So I can say that operationally, we've had a lot of successes. Now, on the execution side of global expansion, one of the challenges is also time. Because I can tell you, whenever I make the connection with an exchange or regulator, I'm like, look, we fulfilled everything. I just want to know, like, if I send the email today, I want the answer yes or no tomorrow. But all of these places, they have their cultures, their processes, their legal frameworks, and their procedures. And you have to be willing to be in it for the long haul. And in a lot of ways, it is a test of patience and attrition. They want to know, are you willing and able to answer all of their questions in a thorough way? And do you have the intestinal fortitude? Do you have the patience to be able to go through the process because in some ways, it's a process of elimination. If you don't answer something right, you don't have the temperament, then your company probably is not the right fit for a market. Because the last thing any regulator or exchange wants is to onboard a company that will bring the exchange, the regulator into disrepute, right? So those are the things that I have discovered. And so it's really, you have to be patient. You have to be very, very methodical. And then from the public company perspective, you have to be able to withstand the fact that there are many people who are armchair quarterbacks who, are concerned with accelerated results and reporting, but in some instances, that's not up to us. I mean, if it were up to us, we get the answer tomorrow. But we have to be respectful as to the rules different countries, different cultures have. And in the long run, I think if you do display that respect and you do things in a methodical way, you end up with positive results. But I do have to say, in the several markets that I've been involved with, it's been nothing but positive, and I look forward to doing more good work with a lot of great geographies.
What does the next phase of growth look like for Valour and DeFi Technologies, respectively? And which constraints will matter most in determining how far and how fast that growth can scale?
I think that's a great question. And it's a question that I think a lot of shareholders are also interested in having. I would look at it like this. Right now, we're in a digital assets downturn. And I tweeted something some time ago saying that, I've always practiced martial arts, and there's a few key principles in martial arts. One is you must always have an impeccable defense. So it's really critical that, particularly with the incoming CEO, we retrench our focus and really focus on doing what we do well, which is we issue instruments, we're focused in the digital asset space, and we make money. We do things profitably. We're not going to take risks. We're not going to make knee-jerk responses to satisfy a demographic or to try and appear to be the cool player in a space where we don't own the technology and we don't know if that particular new space, whatever it would be, is going to make money. So making money is critical. Ensuring that we own our future is absolutely critical. And you own your future by basically ensuring that you've got control over your vertical tech stack. So that's very critical. The next thing is, and I mentioned this previously, is we don't want to telegraph our punches. So whilst we do want to give clarity about, look, we want to own the tech stack, we're heading into the custody space, for instance, we're issuing some of the instruments I discussed here, algorithmic-based, actively managed certificates. We're also in the process of working on a European headquartered ETF equivalent, a UCITS fund. These are things that will bring more institutional flows into our coffers and will also help establish our ability to create new instruments in the post single digital asset ETP era. So that's very, very important. And what is good about these things is they're all things we know we can do. We have a competitive advantage there. There's market demand in those spaces. They are low risk and revenue generating. So that's critical. That's a key area of growth. On a next tier of growth means once we have moved away from a focus on single digital asset underlying instruments, it means you can start to look into the tokenization space, just like we're hearing on a lot of the news channels and whatnot. But the difference is, in the case of our tokenization efforts, our underlying assets are actually liquid. In the case of many tokenization projects, And I know this because I ran a venture fund, a venture capital fund, where we had behind the scenes looks at data rooms of tokenization technology companies. They all, without exception, suffered from a lack of liquidity. Why? Because you can tokenize anything. I could tokenize this pen, but if there's nobody to buy it, to buy the token, if there's no effective market for liquidity for this tokenized pen, all I've done is issue a token on chain and pay gas fees to the chain, but I haven't created any value. So the first thing that you have to do is control the underlying. And this is where our vertically integrated stack of being able to build and run the custody systems, it means the tokens that we issue, we will have institutional custody rails for those tokens that we issue, for one. This is also where the vertically integrated stack of market making and Stillman Digital count, because it means we will also be able to onboard buyers and sellers into whatever tokenized assets that we make. So it's insufficient to just think of tokenization or the entry into the tokenization space as critical. No, tokenization is just a technology. I actually have software on my phone right now that will let me tokenize anything that I want to. But just because I've tokenized it, it doesn't mean somebody's going to buy it. The key to a successful tokenization program is ensuring that the underlying assets have significant liquidity so that the tokens you have move, but this is also critically important. It's also so that if you have tokens that don't move, you're still able to make money from an ongoing business because the underlying asset is of interest. So I would say that that is the core of our growth area going forward from the structured instrument side. I think from the other side, and this is something that I will be discussing this week, we will actually have a press release go out about this, I think sometime this week, is the strength of our data operation. As I mentioned previously, what we have in Valour with having 102 ETPs, 74 single digital asset underlying ETPs, all within a homogeneous market with defined fee structures plus market making with defined market making spreads, we have the makings of an efficient market within a market. So if you buy your Bitcoin via Valour ETP, you have predictability on what the fees are, on what the market making spreads are, and the process, the act of buying is the same as if you're buying through your broker, if you're buying Apple stock or Meta stock through your broker. This means it's easy. Now, why is this important? Well, it's critically important because if you go to many other platforms and you try to buy the coin version of an asset, the price that you see reported on CoinMarketCap or on some website is very rarely the price that you pay because the platform charges fees. Sometimes you don't know what those fees are. The platform charges fees for accepting your stable coin, then charges liquidity fees for accessing the instrument. Then by the time you agree on a price, there's massive spreads. If you're a new buyer and you go onto these platforms, they've got to KYC you. And that KYC process in and of itself takes a ridiculous amount of time. And sometimes you go onto a platform to buy a particular token and you find out that platform is not supporting that particular token. So you've got to go to a new platform to buy that token. That's not the case if you're buying through a regulated broker that has access to Valour instruments. That means that our data operation is able to give a true transparent view of what investors really want and are interested in because the market of Valour instruments across the 102 products that we issue is truly efficient. And what we're going to find is we are going to be issuing specific data-driven products that enable indices, decision making based on the intersection of AUM and inflows, so that instead of just hearing about, let's say, Bitcoin, well, you're also going to hear, well, what token has had significant appreciation, even in the instance of significant depreciation of value of Bitcoin. That sort of thinking, that sort of data-driven approach gives investors the ability to generate alpha on their investments. And when they go to enter, if they're entering via Valour products, the fee structures are absolutely clear because they're written in the prospectus, whether it's 0.5%, 0.9%, 1.9%. It's clear, written in the prospectus. That doesn't change. We can't charge over and above what we've outlined in the prospectus. So these data tools will play a significant role in our being able to provide new types of analytics and our being able to train new types of AI-driven insights that tie digital assets to the traditional finance world. And I'm excited about that. We've been working hard on that.
As for the closing question, where can listeners and institutional partners learn more about Valour's products and DeFi Technologies' broader ecosystem?
Yeah, the best place to go is valour.com, VALOUR.com. That's our website. And also DeFi.tech, DeFi, DEFI .tech. And I'd also like to put a good shout out there for Stillman Digital, which is, I believe it's stillmandigital.com. But Stillman Digital is a really great website for, not website, it's a really fantastic service for large institutional buyers and exchanges to generate liquidity if they need a trading partner, if they hold digital assets, or if you're a large institutional buyer and you're looking to onboard a significant position in digital assets. You don't necessarily want to go to a traditional exchange and put in a bid and realize that it's filled at unfavorable pricing. If you're a portfolio manager, you're dealing with high net worth clients, you're a centralized or decentralized exchange, and you're looking to have active trading pairs against a stable coin and a particular digital asset, you should be calling Stillman Digital because they have a custody license. They're licensed in Bermuda, licensed in the US, international scope, and they provide excellent service for on and off ramp into the world of digital assets and stablecoins.
And how can listeners and institutional partners connect with you? If
Best way to connect with me is via email at andrew@defi.tech. I also have a Valour email, andrew@valour.com, but andrew@defi.tech is great. I'm also on X at Forson, so just at and my last name. And I'm also on Telegram at PA Forson. But Telegram, I get so many messages, they can get lost. So I'd say the best way is email, andrew@defi.tech.
Andrew, thank you for joining us and walking through the architecture of institutional digital asset space. Thank you
Nasib,
very
it's
much.
always a pleasure. Thank you so much.
And to everyone listening or watching, like, subscribe, or follow both of us, and share this episode with someone curious.